Welcome to the Deep Dive, where we cut through the noise of earnings season
and get straight to the insights.
Today, we're diving headfirst into the first quarter 2025 results from Natural Resource Partners NRP.
Right.
We're looking at a company that seems to be, well, navigating some pretty brutal commodity headwinds, yet beneath the surface, they look like they're meticulously positioning for a transformative shift, specifically in capital allocation.
It's a fascinating paradox, really.
It is, and we're here to unpack it for you.
That's right. It's a classic study, market perception versus long-term strategy.
Definitely.
You've got management communicating this cautious yet constructive outlook. They're diligently executing a plan to deleverage.
While the market just sees the clouds.
Exactly. All while the market seems fixated on the immediate cloudy forecast for commodities.
Yeah.
So our mission today is to give you a clear understanding.
The numbers, the strategy.
Yeah, the numbers, the strategic nuance, and where NRP truly stands behind the headlines.
Okay, so let's cut straight to those Q1 2025 numbers then.
Let's do it.
NRP reported GAAP EPS of $2.97. That's their standardized earnings metric, and revenue of $60.5 million.
Well,
on the cash flow side, net income came in pretty solid at $40.3 million. Operating cash flow at $34.4 million, and a robust free cash flow of $35.1 million for the quarter.
And that free cash flow number gets even better if you look back.
It does. If you zoom out to the last 12 months, that figure climbs to an impressive $214 million. Consistent cash generation.
Very consistent.
They also declared a regular distribution, $1.75 per common unit for Q1, and notably paid a special distribution of $1.21 per unit back in March.
Right, and that special one was important. It was specifically to cover 2024 tax liabilities for the unitholder.
Exactly. Keeps things clean for them.
What's truly fascinating here, as you hinted, is the market reaction.
Right, because the numbers look okay, even good on the cash flow front.
Yeah, normally that signals health, but the stock tells a more complex story. Well, it initially firmed up at the market open, even saw a little bump, almost 3%.
Okay, started positive.
But by the day's close, a notable sell-off, ended down almost 4%, and crucially, on a major spike in trading volume.
Ouch. Big volume usually means conviction.
It does.
Yeah.
It signals that investors were peering beyond the current balance sheet and into that commodity crystal ball.
And they didn't like what they saw.
Apparently not. Everything looks rather cloudy right now in that crystal ball.
So if the cash flow looks strong, but the market reacted negatively, it begs the question, what is casting that shadow?
Well, that leads us directly to management's commentary. Pretty sobering stuff.
Yeah.
President and COO Craig Nunez, he made it very clear. He said they expect, quote, weak prices for all three of our key commodities to persist for the foreseeable future and provide a drag on our performance.
Wow. Persist for the foreseeable future. That's blunt.
It's a strong statement, yeah. And it's certainly weighing heavily on investor sentiment.
No kidding.
And it's not just a headwind. It's almost like a perfect storm brewing for their core segments.
Okay, break that down. Let's start with coal.
Right. Metallurgical and thermal coal. Demand for steel, sluggish. Power plant inventories, high.
And the geopolitical situation.
It's a wild card. Exactly. All these factors are pressing prices down to levels management believes are, quote, at or near the cost of production for many producers.
Basically, break even for some.
Potentially, yeah. And here's the kicker. They see no clear catalysts for a near-term price boost.
So no quick fix in sight.
Suggests a prolonged period of pressure for the royalty income from these sources.
So if I'm hearing this right, it's a triple whammy for coal. Weak demand, high inventories, geopolitical chaos.
You got it.
But it's not just coal, is it? Their soda ash segment also seems to be facing significant challenges.
Absolutely. The soda ash story is equally stark, maybe even more so right now.
How bad is it?
Well, this segment saw international pricing decline drastically from those record highs we saw back in 2023. We're talking about an 80% drop in the cash distribution from Seascam, Wyoming. It's NRP's joint venture.
80% drop. Wow.
Yeah, brought it down to just $3 million for the quarter. And the reason? Global oversupply.
Where's that coming from?
Largely due to major 2024 capacity additions, particularly out of China, combined with softer flat glass demand.
Right.
And this combo is expected to weigh on prices well into 2026.
Into 2026?
Yeah. Management described it as being in the, quote, early innings of this soda ash bear market,
Early innings.
expecting it to take, quote, multiple years for global markets to fully absorb excess supply.
Multiple years sounds like a long, tough game. What does that imply for NRP's overall revenue mix if a stream like soda ash is, pressured for that long?
Well, it definitely means a sustained period of lower contributions from that segment, which frankly reinforces the need for their diversification efforts we can touch on later.
Makes sense.
And these commodity challenges, they directly impacted NRP's segment performance in Q1. It wasn't just talk.
Okay, show me the numbers. Mineral rights.
All right, the mineral rights segment. Net income decreased by $15 million. Operating and free cash flow dropped significantly too, by $27 million and $26 million respectively. That's compared to Q1 2024.
And the driver was?
Primarily weaker steel demand, leading to lower metallurgical coal sales prices and volumes.
Okay.
In fact, met coal, the higher value coal, now represents only about 55% of coal royalty revenues and 40% of coal royalty sales volumes.
Down from?
Down from 75% of revenue and 50% of volume in the prior year. A noticeable shift.
That's a very clear shift in their coal royalty mix. Suggests the lower price thermal coal is making up a larger piece of that pie now.
Precisely.
And the soda ash segment, financially speaking, tells a similar story of impact, right?
Exactly the same pattern. Net income for soda ash decreased by $1 million, cash flow by $11 million year over year.
And again, lower prices.
Yep. The main driver was lower weighted average net sales prices as more sales got pushed into that lower priced international market.
Is there any good news there?
Well, the silver lining, if you can call it that, is that Chem Wyoming remained one of the world's lowest cost producers globally.
Okay, so they have some structural advantage.
It provides some cushion, yeah, in what is undeniably a very tough market right now.
It's good to have that competitive edge.
Yeah.
But in contrast to those commodity-exposed segments, I thought I saw something interesting in their corporate and financing segment. Am I reading that right?
You're right to pick up on that. While the overall performance for that segment was, relatively flat, operating and free cash flow actually improved by $1 million.
How?
It was a direct benefit of their debt reduction efforts, lower interest payments flowing through.
Ah, okay.
So this detail, it really highlights the effectiveness of their long-term strategy, right? It shows how disciplined financial management can still deliver tangible benefits even when the wider market is difficult.
And this brings us perfectly to that powerful counter-narrative brewing at NRP.
Yeah.
Their decade-long financial transformation. All about disciplined capital allocation and aggressive debt reduction.
It's been the core story for years.
Management emphasized they are, quote, reaping the rewards of the capital allocation decisions made over the last decade, and they assert their capital structure is solid.
And it's not just talk. The progress is significant. It really sets them apart.
How much debt is actually left?
Their debt status is genuinely impressive now. They have only approximately $139 million of debt remaining on the books as of the quarter end.
And even less now.
Yeah, at the time of the earnings call, Craig Nunez mentioned it was actually down to $118 million.
Wow.
Their consolidated leverage ratio stands at a healthy 0.7x, less than $1 of debt for every dollar of equity. Strong, conservative position.
Very solid.
And they've also laid out a crystal clear hierarchy for how they'll use cash going forward, which is key for investors looking ahead.
What's the priority list?
Okay, number one, maintaining strong liquidity and balance sheet strength. No surprises there.
Standard proof.
Number two, and this is where it gets really interesting for unit holders. They anticipate, quote, significant increases in unit holder distributions as debt is paid off next year.
Okay, that's the payoff for patience. Significant increases.
That's the phrase they used. Only after that do they consider opportunistic unit repurchases. And even then, only at, quote, material discounts to intrinsic value.
So buybacks are conditional.
Very conditional. And right at the very bottom of their priority list, opportunistic acquisitions.
Acquisitions are last. That's unusual for some companies.
It shows a real commitment, I think, to returning capital once that debt hurdle is cleared next year.
That commitment to distributions coming next year, that feels like a potential game changer.
It really could be.
But beyond managing their existing assets and debt, NRP is also sort of quietly building foundations for a very different future, right? This long-term diversification idea.
That's the other piece of the long game. They're actively exploring carbon-neutral revenue opportunities, leveraging their extensive land footprint.
What kind of things are we talking about?
Initiatives like coke yard sequestration, forestry, lithium exploration, geothermal, solar, wind projects.
Whole portfolio of green options.
Right. And importantly, they're framed as low capex options, meaning they don't expect to sink massive amounts of their capital up front, more like enabling others on their land.
Interesting model. Leasing or royalties, maybe?
Potentially. But this raises an important question for you, the listener. While the timing, the likelihood of future cash flows from these initiatives, it's all pretty uncertain right now.
True, it's early days.
How significant could they eventually become? Could they truly diversify NRP away from the volatility of coal and soda ash? That's the long-term question.
Where are they now with these? Any traction?
Well, currently, leasing interest for underground carbon sequestration is described as lackluster,
Why is that?
primarily due to political, regulatory, and market uncertainties around carbon capture right now. It's complex.
Fair enough.
However, they are making some small-scale progress in geothermal, solar, and lithium exploration. Tiny steps.
It's a bit like planting saplings today, isn't it? Could grow into a forest tomorrow.
That's a good analogy. A very long game, but definitely a strategic pivot towards potentially higher quality, less cyclical revenue streams down the road.
Okay, so given all this, the strong cash flow, the disciplined path to deleveraging, this long-term diversification play, but also the immediate, heavy commodity headwinds, how did the market ultimately digest this Q1 call? You mentioned the sell-off.
Yeah, we saw that initial bump at the open, trading briefly near $105.
Right.
But by the close, it had sold off significantly to $98.
Right.
And that trading volume spike was huge, jumping from around 3,300 units the day before to nearly 50,000 units on the day of the call.
50,000. Wow, that's a massive increase. A lot of people changing their minds or taking positions.
Exactly. That intense sell-off on such a high volume, it really suggests that investors weighed that negative commentary, the weak commodity pricing, the lower soda ash distributions, far more heavily
Then the good news.
than the positive news about deleveraging progress and the prospect of those increased future distributions.
Yeah, it's a classic case, isn't it? Short-term headwinds completely overshadowing that longer-term potential.
Creates a strong show-me sentiment around the stock. Investors want proof, not just promises, especially when the present looks tough.
It's like watching a chess game where half the audience is only focused on the pawns.
Missing the queen's strategic move coming in 2 turns. Yeah, something like
It's
that.
always fascinating how the market can be so myopic sometimes. So, for those looking ahead, what are the key catalysts? What should we be watching over the next, say, 6 to 12 months that could really shift this narrative?
Okay, several things could influence NRP's trajectory. First, quarterly updates on coal royalty volumes and prices. We need to see how they track against their own muted guidance.
Performance versus expectations?
Exactly.
Yeah.
Second, any evidence that the soda ash market is starting to rebalance would be crucial, given that multiple years forecast.
Signs of life in soda ash.
Third, we need to see if they actually execute any agreements for carbon sequestration or renewable energy sites. That would signal tangible progress on the diversification strategy, make it more real.
Move from potential to actual projects.
Right. But most critically, I think, is formal confirmation of the debt retirement, seeing that debt actually hit zero or near zero. And then the updated distribution framework.
The details on those significant increases.
Yes, that will truly mark the pivot in the narrative arc. From deleveraging to distribution growth, that's what patient unit holders are really waiting for.
And what about M&A or selling assets? Are they looking to expand or trim the portfolio as they shift focus?
Management made it pretty clear. They are long-term holders of assets. They don't plan to sell.
They like what they own.
They view themselves as royalty and mineral owners, aiming to maximize value over time. And acquisitions, as we noted, remain their lowest priority for cash.
Focus is internal.
They also mentioned, interestingly, that changing administrations haven't had a dramatic impact on their business over the last decade, and they don't anticipate significant legislative or executive impacts now. Suggests a stable, if cyclical, operating environment from their perspective.
All right, now for our not financial advice segment, purely for thought-provoking discussion, we're looking for an outrageous yet somehow plausible trade idea here. What have you got?
Okay, given NRP's really unique position right now, facing those serious commodity headwinds, yes, but also being right on the cusp of fully deleveraging and promising those significant increases in unitholder distributions next year.
That contrast again.
Exactly. Here's a thought for you. Consider a long position in deep out-of-the-money call options for NRP.
Deep out of the money calls. Okay, define aggressive. When would they expire?
Expiring in, say, Early 2027.
Early 2027.
Wow.
So giving it time past the debt payoff. And deep OTM means you need a big move.
Precisely. For those less familiar, these are aggressive bets on a significant price jump. They offer high leverage if the stock really takes off, but also carry high risk if it doesn't move enough or moves too slowly. You could lose everything.
Definitely not for the faint of heart. Tell us more about the rationale behind that long-term high leverage bet. Why 2027 calls?
Well, the market has clearly punished NRP for its current commodity environment. We saw that with the Q1 sell-off. It's pricing in the bad news now.
Okay.
However, the completion of that debt payoff, which should happen in 2026, followed by that promised substantial increase in distributions, that could act as a really powerful re-rating catalyst.
Something the market isn't fully appreciating today.
Exactly. Something the market just isn't fully pricing in today, focused as it is on the near-term pain. This trade lets you try to capitalize on that potential capital return inflection point.
So you're buying exposure to the future distribution story.
Essentially, yes. You're buying exposure to the future distribution growth story and the optionality of those carbon neutral initiatives kicking in eventually, while trying to sidestep the current commodity volatility.
Using options to isolate the future potential.
Right. If management delivers on those distribution promises, the stock could see a really substantial re-rating. That could make these calls highly profitable thanks to the leverage. It's a bet on the long game, using options to amplify a potential future value unlock once that debt burden is truly gone.
Definitely outrageous, but you laid out the plausibility. Food for thought.
Absolutely. Just a thought experiment.
So there you have it. Natural Resource Partners navigating a truly challenging Q1 2025. Strong cash generation, disciplined debt reduction, building a solid foundation.
But definitely overshadowed right now by those significant commodity headwinds.
And the market reacted negatively, fixating on the immediate future.
Indeed. The company is at such a pivotal point, nearing the end of this decade-long deleveraging journey that has significantly strengthened its balance sheet.
So the real question
For investors, for you listening, is how much of that long-term distribution growth potential and that embedded optionality from their carbon neutral initiatives, how much of that is currently being overlooked by a market fixated on the present commodity cycle?
What happens when that debt is gone?
What does the future hold once that debt is truly gone and all that cash flow is fully unlocked for unit holders?
It certainly gives you something profound to consider as you watch this company evolve. Thank you for joining us on the deep dive.
Our pleasure.
We always encourage you to do your own research and due diligence. This deep dive is strictly for informational purposes only and is absolutely not financial advice.
Please consult a professional.
We'll be back soon with another deep dive into the latest earnings calls.